Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sun Country Airlines Holdings Inc. Annual Report. Sun Country Airlines Holdings Inc. offers a diverse range of services to cater to various customer needs. The company operates scheduled passenger flights, air cargo transportation, and charter air services within the United States, Latin America, and internationally. In addition to these core services, Sun Country provides aircraft, crew, maintenance, and insurance services through various contract types. The company also offers loyalty program rewards and ancillary services to enhance customer experience. Its fleet consists of 70 Boeing 737NG aircraft, including passenger, cargo, and leased planes. Sun Country serves a broad spectrum of customers, including leisure travelers, charter and cargo clients, military branches, sports teams, tour operators, schools, companies, and individual entities. The company's services are accessible through its website, call center, and travel agents, making it convenient for customers to book flights or request services. With over 40 years of experience, Sun Country Airlines Holdings, Inc. has established itself as a reliable provider of air transportation and related services. The stock price of Sun Country Airlines Holdings, Inc. SNCY has seen a significant increase over the past year, rising by 16.88%. This surge can be attributed to several key factors. One major contributor is the airline's robust earnings reports. In its fourth quarter and full year 2025 results, Sun Country reported record-breaking revenue of $281 million, surpassing consensus estimates. This marked the 14th consecutive quarter and 5th consecutive year of profitability for the company. Analyst upgrades and increased price targets have also played a significant role in boosting SNCY's stock price. Several financial analysts, including Susquehanna, Citigroup, Cantor Fitzgerald, TD Cowen, and Zacks Research, have revised their outlooks positively, raising their price targets to as high as $22. The announcement of an acquisition agreement with Allegiant Travel Company has further influenced the stock. While some analysts adjusted their ratings due to the merger's pricing, they also nudged fair value estimates higher, citing potential for margin expansion. Additionally, Sun Country's strategic business developments, such as its plans to establish a new operational base at Cincinnati/Northern Kentucky International Airport, dedicated to supporting its cargo operations for Amazon, indicate a move to diversify revenue streams and foster growth. The airline's leisure-focused business model has also been viewed as advantageous in navigating the broader airline industry's recovery. Overall, these factors have combined to drive up SNCY's stock price, positioning it favorably within the market. Sun Country Airlines Holdings, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $6 billion. Sun Country Airlines Holdings, Inc. trades at a higher price-to-earnings ratio of 22 times, and a higher price-to-book ratio of 1.8 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be categorized into several key areas. Revenue growth is primarily driven by scheduled service revenue, charter revenue, ancillary revenues, and cargo revenue. These categories contribute significantly to the overall revenue of the company. Scheduled service revenue, which includes base fares, is a major contributor to revenue growth. Charter revenue, which involves providing services to specific clients such as sports teams and casinos, also plays a significant role. Ancillary revenues, including baggage fees, seat selection fees, and onboard sales, are another important driver of revenue growth. Cargo revenue, which involves flying cargo aircraft for companies like Amazon, is also a key contributor to revenue growth. In addition to these categories, geographic region revenue growth or decline, such as domestic revenue and Latin America revenue, also impact the company's overall revenue. Other drivers of revenue growth or decline include amortization expense on other intangible assets with finite lives, rental revenue from subleased aircraft, future undiscounted cash flows expected to be received in 2026, finance lease cost, and operating lease cost. These factors can either positively or negatively impact the company's revenue growth. Overall, a combination of these drivers contributes to the company's revenue growth or decline. While some areas are not explicitly mentioned, such as revenue growth or decline metrics for specific regions and key drivers of revenue changes for specific segments, the summaries provide a comprehensive overview of the company's revenue growth and decline drivers. Net income and profit margins experienced fluctuations between 2023 and 2025. Initially, net income increased by $19,278 from 2023 to 2024, but then decreased by $94,000 from 2024 to 2025. This decline in net income was largely due to volatile fuel prices, security costs, revenue losses from terrorist attacks, and disruptions caused by adverse weather conditions. Profit margins also underwent changes during this period. Operating income margin decreased from 9.9% to 8.9%, while adjusted operating income margin dropped from 10.4% to 9.7%. However, the passenger segment profit margins declined from 10.8% to 10%, whereas cargo segment profit margins increased from 1.1% to 2.3%. The reasons behind these changes in net income and profit margins were multifaceted. Increased governmental fees imposed on airlines, higher operating costs due to enhanced security measures, decreased demand for air travel due to customer inconvenience and public health threats all contributed to the decline in profit margins. These factors ultimately led to a decrease in net income from 2024 to 2025. The company's financial performance indicates a positive trend in operating cash flow. According to the provided information, the net cash provided by operating activities for both 2024 and 2025 was substantial, with figures of $157,106, thousands, and $164,862, thousands, respectively. This suggests that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. The analysis of the company's debt level and interest expenses reveals some significant changes over time. Initially, on page 71, the total debt decreased by 1% from $327,122 to $323,346. However, this trend is not consistent across all periods. On page 106, a notable increase in debt level is observed due to the addition of a revolving credit facility and a term loan facility, which pushed the debt up to $183,000. Despite fluctuations, the interest expenses have shown a more consistent decline. According to multiple sources, pages 61, 64, 67, and 82, the interest expense decreased by 17% from 2024 to 2025, indicating a reduction in the company's financial burden due to lower interest rates or debt repayment. It is worth noting that on page 89, there seems to be an inconsistency in the change in interest expenses, with a decrease of $7,834, thousands, from 2023 to 2024, and then an increase of $-8,534, thousands, from 2024 to 2025. However, this anomaly is not reflected in other sources. In conclusion, while there have been fluctuations in the company's debt level over time, the interest expenses have consistently decreased, indicating a positive trend for the company's financial health. The performance of various regions and segments in the market has been analyzed. Regions such as Minneapolis-St. Paul and international markets have underperformed, while domestic markets have shown an upward trend. In terms of segments, scheduled service and ancillary services have seen a decline in performance. Latin America also experienced a decrease in performance. On the other hand, charter services have shown an increase in performance, bucking the trend of declining growth in other areas. Management's primary goal for Sun Country Airlines is to establish itself as a high-growth, low-cost carrier in the U.S. by offering competitive fares and delivering exceptional customer experiences. To achieve this, they are diversifying their business model to mitigate potential downturns and adopting a flexible strategy that allows them to adjust services according to market conditions. A key area of focus for management is growing the cargo segment, which is expected to continue expanding due to contractual rate increases and new aircraft additions. They plan to increase resources allocated to this segment by operating more aircraft for Amazon. Additionally, they aim to manage costs through operational challenges and offset the effects of pilot pay increases and other expenses. Management also emphasizes the importance of prioritizing general corporate purposes over investing in new assets. This approach will enable them to take advantage of favorable interest rate environments to refinance debt and reduce costs. Furthermore, they plan to expand participation in fuel consortia with other airlines where economically beneficial. Overall, management's strategy is centered around growth, cost management, and strategic investments that support the company's long-term success. The acquisitions and divestitures of the company can be summarized into several key points. Acquisitions include a proposed merger with Allegiant, which was finalized in a subsequent transaction. The company also acquired shares of Sun Country common stock from Allegiant. Additionally, the company entered into an agreement with Amazon to increase the number of Boeing 700 and 737-800 cargo aircraft from 12 to 20 by 2025. Furthermore, the company refinanced 5 Boeing 700 and 737-900ER aircraft through a term loan facility in September 2025 and acquired several engines, spare parts, and other items. The divestitures include the sale of Hawaiian Airlines, although the details of this transaction are not specified as an acquisition or divestiture. The company's financial activities have been notable in recent years. One significant development is its payment of dividends to shareholders. Although these dividends were non-cash in nature, they still represent a commitment to returning value to investors. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it repurchased $20,015 worth of shares during the year ended December 31, 2025. This move is aimed at reducing the number of outstanding shares and potentially boosting earnings per share for remaining shareholders. That concludes the financial summary for Sun Country Airlines Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.